Alright, cool. I think we should be recording. Just going to whack that over there. But yeah, today's video is basically a quick trade analysis on Chegg, ticker symbol CHGG. And essentially what Chegg is a direct-to-student learning platform. I think anyone under the age of like 30, who's gone through the university or school system has essentially come across Chegg one way or another when you need help on some homework or in the lead up to your exams and when you're doing some revision. So the business model is essentially currently based around this via a subscription-based service where the majority of Chegg's revenue is actually generated. So they have like the study pack, writing tools, which like does like plagiarism detection for like when you do what do you call it, like essays and coursework, and then like a math solver, which is apparently really good, and then prep tool, which is like digital flashcards for like studying again in the lead up to exams. They also have some other business models. So one is like a textbook rental and sales, which if I'm not mistaken is quite a small part of the business and doesn't actually generate much revenue. They have an online tutoring part of the business, which I'll come on to later, which I think will be very important. They also have a skills development part of the business, which is just focusing on professional skills like coding, data analysis, how to interview for jobs, like interview prep, things like that, which again I think I'll come on to later, which I think will be very important. And then an ad revenue part of the business, which again is neither here or there. It generates some decent income, but that's about it. And so I guess like a summary of the current themes and the essential trade thesis regarding and surrounding Chegg is purely derived off the fact that it's down 99% from its all-time highs from 2021. And obviously the reason for this is because of ChatGPT and other, I guess, language learning models and just chatbots with the use of AI, right? Where now students can essentially for free go onto like applications like ChatGPT, ask it quite decently complex questions, and for the most part get a pretty decent answer. And from that, a lot of the people who are quite reluctant to spend money on services that Chegg provides are now basically no longer paying. And so what has happened now is Chegg has seen a massive decline, or a significant decline at least, in its subscription users, and obviously thus a massive fall in business and revenues. But essentially, so the cost-cutting measures, which I think is probably the most important thing here, because I think the decline in revenues is inevitable, but what the real, I guess, task of management is essentially to cut costs in line with revenues falling, so that they basically maintain their positive free cash flow generation and profitability. So obviously one of the four things they're doing is restructuring the workforce. So they're having quite significant layoffs. So obviously again reducing the workforce to align with the cost structure with the revenue trends, as I explained. And then they're also streamlining the operations in general in critical business areas, which again overall is quite positive from I guess a shareholder perspective. They're also reducing marketing and operational costs, so like discretionary spending, and lowering investments in areas which essentially are not going to yield much return. Obviously, the downside to this is the fact that they're basically kind of admitting that they're not going to go for any growth at the moment. They're not really looking forward, and it's more of like survival, which again, the way I struck the trade, for me, I don't really mind. I'm not really buying or trading the stock as a growth play. So yeah, they are, to be fair, talking about strategic investments in AI. But as I'll get onto later, I think this is actually kind of shooting themselves in the foot, because their real moat and I guess benefit to their business is that human expert advice that students can receive on their platform. So if they just become like any other AI platform, then they're essentially at that competitive advantage they have currently in the market, they're essentially basically killing. And then again, customers are just going to go to the better AI platforms to get their answers. And then here they're saying they're exiting low margin operations, so stuff like the textbook operations, which, as I said, I don't think generates much revenue and is pretty pointless in today's age, where you can get textbooks and stuff pretty much for free if you know where to look. So yeah. So as always, I do like a KPI analysis, one on the financials and then one on like basically operational or non-financial KPIs. So with the financial KPIs, I recommend focusing on. Obviously, top one is net revenues. You want to see the kind of business and trade year in, year out of the company. And as you'd expect, year over year is declining. So as of the last recent quarter, it declined by 13%, which again, you'd expect. Subscription service revenues, which, as I said, basically the major bulk of their revenues come from, as you can see, is down 14% also. And then gross margins, the gap gross margins are even, but the non-GAAP gross margins are down year over year, where last year was 76% and this year is 70%, which I think is quite concerning, because again, the play here is essentially for them to cut costs in line with revenues dropping. So you'd want gross margins essentially to at least stay flat. But to be fair, like I said, the gap gross margins are doing that, so there is that at least. The net loss obviously was very significant, but the only reason for that in the recent quarter was because of a 196 non-cash impairment charge related to goodwill. So anybody who knows about accounting and things, essentially they'll know that goodwill is like a non-existent asset really. It's an intangible asset, so it's not really physical or like an actual real thing. It's more of like an accounting adjustment that you kind of create and put through. And so all they've done is just basically write this goodwill off as an impairment charge, essentially reflecting that the valuation of the business is not what it once was. And so yeah, the actual net loss is been highly inflated by a non-cash impairment charge. So I wouldn't worry too much on this very significant net loss going forward. Anyone who doesn't know, EBITDA is just earnings before interest, taxation, depreciation, and amortization. Again, it's a very accounting thing, but it's kind of looking in line with cash flow and the real cash profitability of the business. And from that, again, it's positive. So that's, again, a nice thing to see. Although, if you look kind of more into the numbers and compare it to prior year, so Q3 2023 is actually down quite significantly, where last year it was 38 million in positive EBITDA, and this year it's only 22. So it is declining, unfortunately, which again is in line with the gross margin non-GAAP declining. So you do want to see them start cutting costs properly now going into 2025. And then looking at the cash and investments, we get onto this a bit more in the cash runway analysis, but essentially they currently have 631 million in cash versus a debt position of 630 million, which is not great, not bad, pretty neutral, but it basically just means that they're not highly indebted, which is nice from, again, a cash flow perspective going forward. In terms of analysing the non-financial KPIs, there's three primary ones you want to look at, which is the total number of subscribers, the number of questions asked on the platform, so basically looking at how much is the platform and is being used, and then the Chegg study pack, basically the monthly retention rate of how many, students are continuously keeping up with their subscriptions. And so obviously the first one, as you'd expect, it's down 13% year over year, in line with revenue being down 13% year over year. But they still, to be fair, have 3.8 million subscribers, which it's like a decent number, and I do expect this to continue to fall down, especially as AI gets better and better. But again, as I said, if they can focus on becoming a niche platform and a niche player in the education sector, I don't see this going, I don't see it being catastrophic in terms of how badly it declines. Because while 13% is significant, it's not like a massive, 30, 40, 50% drop in a year of the business. So there is at least that. And then on top of that, the total questions asked on the platform was actually up a significant 74% compared to the same time last year. So reflecting a heightened engagement on the actual platform, which again is another very good positive to see. And then the monthly retention rate, improved slightly, pretty much to 78.5%, whereas last year was basically 78.3%. So again, suggesting decent user satisfaction and loyalty on the platform. Some other comments I've made here. So obviously, as I like when I analyze a business and kind of look at the actual qualitative aspect of the business, I like seeing what users and customers are saying. So obviously, classic Reddit post here. Came across one where basically this Reddit user made a title saying Chegg is awful since the AI update. Any alternatives? Which again isn't the most bullish signal. And essentially what they said here was that instead of how it used to be in the past, with experts answering the questions and giving proper explanations, then now you're basically paying for a service that gives wrong answers, which is just written by AI, who doesn't know anything maths related for the most part. So you can no longer use it as a study tool. Which again, as I mentioned, and I've been saying since the start of the video, is that this is essentially their moat, right? Compared to AI, is the fact that when you go on Chegg, you ideally know that you're getting a human response from an expert, usually in that field, and the answers are just generally going to be to a higher quality and standard. And I think at least in the next 1 to 2 few years, I don't know how long it's going to be, I feel like Chegg really needs to knuckle down and focus on this aspect of their business, versus obviously competitors like ChatGPT, which are using AI, which can't really provide that same level of quality and human interaction. But I think that's an overall review of the KPIs and the qualitative aspect of the business. Overall, the financial performance looks pretty grim and hopeless, if I'm being honest, but there is some nice positives, or if you kind of look under the hood, where again the net loss isn't actually as big as it is. The US GAAP gross margin has stayed the same, and then they got a decent cash position. So that brings us on to then the cash runway analysis, or the beginning of the quants part of the analysis. And for me, this is probably one of the most important things to look at for this kind of stock trade. And so if we look at the financial position of the company, we can see cash and investments of 631 million, a positive EBITDA, as I mentioned, and then positive free cash flow in the last quarter of 9.7 million. And so doing a quick cash runway analysis, so for anyone who doesn't know, all cash runway analysis is just looking at the cash reserves, so 631 million, and then dividing it by the quarterly cash burn. Obviously in this case, there isn't a cash burn because they generate positive cash flow. And so obviously I made here, as long as Chegg can maintain their positive free cash flow, it can extend indefinitely under current conditions, which basically means they never will go bankrupt, right? Which of course is a great positive. And then I basically then made a negative cash flow scenario. So I said, okay, say hypothetically the business keeps declining and then they get to a point where they have a 20 million quarterly cash burn. Obviously with the current cash position, that will then result in about just under 8 years again of cash runway. So as long as even if they become loss making and then don't generate positive free cash flow, as long as they can kind of temper it and not make it excessive, the business can kind of run for quite some time. And especially with, again, I've mentioned this so many times now, but the trade structure I've put in place, it's not really much of a worry for me, as long as they can basically survive this next year, which is pretty much looking very likely. There's nothing too much to worry about. And I also kind of mentioned here again, the focus on trying to save 100 to 120 million starting in 2025, which will help all of this. Alright, cool. So that then brings me to the main bulk and I guess the main focus of the analysis, which I guess you guys will want to look at and are probably interested in, which is the price target, the trade structure, fair valuations, all of that good stuff. So obviously 104 million shares outstanding. Doing a quick analysis, as I always do, in terms of the overview. We can see here, as of the end of 2023, the stock price was $11, which gave it a 1.3 billion market cap. They had EPS of a normalized EPS of $1.1 a share, basically, with that, which gave them a price to earnings ratio of 10. And then they also had a sales multiple at the end of 2023 of 1.84. So essentially coming up with a valuation for Chegg, I essentially had two scenarios, an optimistic case and a bear case. Obviously, again, I won't go too much into this whole thing. You can kind of either pause the screen and read it yourself. Probably should zoom in actually. There we are. But yeah, you can. I hope you guys could have. I just realised I've not actually zoomed in on all the other pages, so I'll just kind of flick through them now in case you guys want to pause the screen and read them. Or again, just go to the top link in the description and you'll get to the website and grab it for free. But and read it yourself. But anyway, so yeah. So essentially, I've done like a optimistic case and a bear case. As you can, if you pause the screen or download the file, you can read here. I've kind of disregarded completely the optimistic case, as I just don't think it's possible, because the optimistic case essentially assumes that Chegg can kind of reverse their issues that they're having and kind of go back to like even just 2023 levels, which probably sounds like a rather base case, but it really isn't, because again, I just don't see them ever going back to what they once were. I think now they have to focus on being a niche business in the education sector, and because of that, I've kind of completely focused on the bear case here. And so the bear case essentially, one looks at the price to earnings, and one values the company based on its sales. And so the price to earnings evaluation, if anyone doesn't know, usually when you have like distressed companies like this, which are teetering, the stock at least is trading as if it's teetering on bankruptcy, basically obsolescence, where the business model has kind of like essentially been eradicated via innovation. Usually what you would do is assign a PE ratio of around 3, which then based on 2025, again, because now we're based in 2025 now, because you kind of disregard FY24 estimates, but based on 2025 estimates, where we have an EPS estimate by both management essentially and Wall Street analysts of around 66 cents, it would give pretty much a valuation of just under $2 a share. And then the sales multiple, again, usually for distressed companies, we usually like giving 0.5, 0.4 sales multiples. So here I've kind of been nice and trying to get the upper range of the price target range. And for that, I've given a sales multiple of 0.5, which then based on the projected sales in 2025 of just under 520 million, gives a price target of just under $3. So which then obviously gives us our price target range between these two, which then obviously the median is just $2.47. And so that's kind of the price target I would assign Chegg. I would not recommend buying Chegg around $3 or $2.47, to be honest. It's more like an exit price if you were to buy at current prices, which, to be fair, does, I think today's price, or yesterday, because today's Saturday, but as of yesterday's price was $1.65. So that is like some decent upside, in fairness. Let's double check. So yeah, that's like 50% upside. So not too bad if you were just to buy straight shares right now and hold it until that price target of around $2.50. But I think there's basically much better ways to trade Chegg at the moment, which then basically lets me come onto my trade structure, which is essentially to sell puts on Chegg at $1 strike prices with currently the 18th of July expiry. The reason the expiry is so far out, as I usually like selling options contracts at maximum like 3 months out, ideally 1 to 2 months out, but just premiums, obviously with the stock price being so low, the premiums on the contracts are very low. Like even this premium here is 20 cents a contract, which is about $20 obviously in total in premium. So if you did like a hypothetical 5 contracts just to get a nice rounded premium of $100, as of obviously when I was on IBKR, just seeing what the margin requirements and stuff were, it was around $324 to put this trade on, which then I guess represents a 31% return on margin and an annualized return. Again, just if you I'll scroll down, you see the formula here. The annualized return would then just be 57%, which obviously compared to like your cash saving ISAs, obviously is very nice compared to just letting it, even at current interest rates, getting 5%. It's kind of nice to get that kind of return. It's very nice. And then obviously you always want to look at risk and downside, because here you are selling put contracts. So if the put contracts were to get assigned to you and then you end up owning the shares, it's kind of a win-win basis, which again I kind of explain here in terms of why I've chosen this structure. But essentially what would happen is your break-even share price then for Chegg would be around 80 cents. So then if you were assigned the 500 shares, your total risk exposure is only $400, which is pretty good to be honest. And essentially all this is stating is if you get assigned the 500 shares and then Chegg like goes bankrupt, the stock price goes to zero, the most you will lose obviously is the $400 total dollars invested, which of course then represents a return percentage on the total risk exposure of 25%, and then again annualized it's about 46%. So yeah, not too bad, not too bad. Cool, and I've basically everything I've just said I kind of explained here. But basically, yeah, the risk to return is very, very good in my opinion with this trade structure. And the reason for that is primarily not because of the return, but because of the risk here. And the reason the risk is so good is because the probability of being signed is very low. And even if you do then get assigned, it's actually quite favorable. As I've said here, the reason the probability is very low is because the stock is essentially trading as if it's heading towards bankruptcy. It's nearing all-time lows and it's down 99% roughly from its all-time highs in 2021. And then as we've seen from our cash runway analysis, the likelihood of bankruptcy definitely by the 18th of July expiry is pretty much non-existent. And then obviously then being signed the put contract, so say the stock price just absolutely tanks, then in that hypothetical scenario you would get obviously 500 shares of Chegg at around 80 cents a share, which again at that point I did a quick like very rough analysis on the liquidation value. Just put the thing down here. And as you can see here, like the worst base case of like a realizable assets less settling liabilities, you get like a per share basis of like 40 cents. So you're pretty much at that point getting assigned shares at 80, pretty much like not too far off from its liquidation value, which I think is quite favorable. And so essentially with this trade, you either collect a premium and earn a pretty nice annualized return on the margin and risk exposure. I just realized I need to update those figures. Or you're basically assigned the shares at a cost basis of around 80 cents, which again from my analysis where I've basically said that the fair value price target is around $2.40 is very favorable, where you're getting shares that are very heavily discounted price. Cool, yeah, so I think that's everything I wanted to get across. Essentially the main part of, like I said, trade analysis here was not that Chegg is some amazing stock that's going to go to the moon, it's going to 10x, but rather there's a really good play here, I believe, from the fact that stock's being beaten up so much with the use of options contracts, and that I just don't see Chegg, essentially, at least in 2025, going bankrupt anytime soon. So yeah, obviously if you enjoyed the video or if you have any questions, more importantly, just leave them in the comments. I'll get around to them. Otherwise, I'll leave you guys there.